Hello there, my name is James Smith. Thank you for joining us today, and I'm joined by Grant Patterson, our CIO. Grant, welcome.
Thanks, James.
We've titled this quarter's Global Outlook and Strategy the most diversified in 20 years. Could you just articulate what we mean by that?
Well, James, we've had a very, very strong run in markets, particularly over the last 12 months, and valuations across all asset classes, in our view, are very full and stretched. So we're quite concerned about those valuations, and therefore we're remaining very diversified. In fact, the most diversified we've been in the 20 years of investing on behalf of our clients.
And so let's just chat through some asset classes with regards to that. So with regards to equities, could you just comment on where we're seeing these pockets of excess valuations?
Yeah, well, the global equity market last year was up 28%, and that was driven solely by multiple expansion. Hardly any earnings growth. And that was a function really of the Fed balance sheet that is very accommodative, keeping interest rates ultra low, and investors are finding no other place to put their money except for equities, if you like, or growth assets, and pushing those valuations up. So in the States, very expensive, driven by the tech stocks, and we'd be avoiding the US as such at an index level. Australia also very, very expensive, particularly in the industrials ex-banks. I mean, the market here is trading on over 2 standard deviations higher than its long-term average, so that's a big caution for us. So the markets that we prefer on a relative basis, if you like, is Europe and Japan.
And with regards to property, again, we're seeing excess valuations there. Where are we finding opportunities within property, and why?
We're finding some opportunities in the direct area. I mean, the listed REITs are very, very expensive, trading now at 35 to 40% premium to their NTAs. And in our view, valuations do ultimately matter. So we're not invested at all in that in the REIT indexes, if you like. Within direct property, the last 3 or 4 years we've been undertaking due diligence on regional hospitality assets, and we're about to back a fund that will invest in that sector. The reason why we like the sector, it's very fragmented. A sector. It's non-correlated, if you like, to the general economic cycle within the cities. They're usually run by mums and dads, and we think by growing a fund, professionally managed, centralised booking, operational improvements, we find that quite an attractive sector because it's valued on the cash distribution and income rather than on cap rates that the markets may be playing.
I'd like to touch on credit. For those who've been following our narrative for the last 12 months or so, we've been quite concerned about the sort of billowing out level of credit and some of the signals that we're seeing there. Could you just touch on what we're focused on there within credit?
Well, there are some signs of stress, and this has been a function of money flowing out of term deposits or bank accounts to try and get some sort of yield, but you're taking much more risk in order to do that. We've seen some stress even in the repo market in the States, which is the overnight funding between the banks. Central bank has had to come in and provide liquidity in that market. So we're watching that very closely. In the non-investment grade sector, CCC credit spreads are widening, which is indicating the potential for increased level of defaults in the future. And in the investment grade sector, we've seen there a deterioration, if you like, of the fundamentals, where leverage has been going up and interest coverage has been declining. So we're a little bit concerned about that. Our focus really is on asset-backed securities. We still think looks on a risk-reward basis okay. And also within Australia, first mortgage, fully secured property debt, yielding around 7 to 8%. We quite like that sector, given the security that you have.
And to capture some non-correlated asset exposure, we've used alternatives, focus there being gold and private equity. Could you just explain the rationale behind that?
Yeah, well, once again, wanting to remain very diversified across all asset classes, we have been investing in alternative funds, which could be long short to try and protect yourself in a market downturn. Private equity, we had a large investment there for some time, done exceptionally well, but valuations are very stretched there now, and we can see that what happened with WeWork, that were valued at one stage at 47 billion and has now been recapped at 8 billion. Valuations just got excessive. So we've sold out of the private equity and replaced that with gold. Gold is really in the portfolio as a pure protection mechanism to protect any downside if there is a market dislocation.
And just on that, most recently the coronavirus has got markets rattled. Do you just want to touch on how that's impacting volatility and human behaviour?
Yeah, well, I mean, the global growth looked like it was going to pick up, towards the end of last year and into this year, and the leading indicators were quite positive. Clearly, the coronavirus has now put a dampener on that, and we don't know the full economic and human outcome of that as we speak. Markets are now, I suspect, will correct probably by the time we go to air here, and we'll just have to see where that settles down. But it will definitely impact global growth, and I think markets will be quite unsettled during that period of time.
And as Providence enters its 20th year of caring on behalf of investors, what are some sort of key messages that you'd like to share with us?
Well, it's been an interesting journey over the last 20 years, James, but one thing that struck us, one thing that doesn't change is human behaviour. The herd mentality where, everyone sort of tends to flow into the same thing at the same time. Valuations do matter, and although you can't time the markets and know when that adjustment will occur, the last 20 years have shown us, whether it be .com boom or bust or GFC, that ultimately valuations do matter, and you want to make sure that you're quite happy to own the assets in a market downturn.
Thanks for that, Grant. And are there any Providence news you'd like to share with us today?
I'm delighted that Melissa's back now after maternity leave and back on board, so it's great to have Melissa back in the office, and we're looking forward to the celebrations over the year for our 20th year, and look forward to seeing all of our clients at those functions, and thank our clients for their support over the last 20 years.
Thank you, Grant, and thank you for listening, and we look forward to sharing our thoughts and views throughout the year. Thank you.